Somewhere in a marble building on Constitution Avenue, 12 people argued about your money 3 weeks ago. And on Wednesday, the transcript of that argument becomes public. It will not read like news. It will read like a legal brief written by people who have never met a semicolon they didn't like. And buried inside that dry, bureaucratic prose is the single most important piece of information gold and silver investors will get all month. Most of them will not know how to find it. This channel exists on a simple premise. The research that actually moves precious metals markets is usually hiding in plain sight, disguised as something boring. Nobody reads the minutes carefully. Almost everybody should. So today we are doing two things, in the tradition of a good newspaper column: long on context, short on nonsense. First, a precise field guide to the document dropping next Wednesday, the kind of guide you could not get from a headline if you tried. Second, an explanation of something stranger: why gold and silver, two metals that hit their all-time highs on the very same trading day this master the metals market with the ultimate silver trading manual. Launched just last week, over 1,000 traders have already grabbed their copy and are leveraging these proven strategies, with many buyers reporting thousands of dollars in profits. This is your one-time investment to unlock not only an action-packed trading guide, but also exclusive free access to our private Telegram and WhatsApp community. Inside, you'll get ongoing real-time support, market updates, and direct guidance to help you execute confident, profitable trades. Don't sit on the sidelines while others capitalize on the market. Grab your copy now and transform your trading today. January have spent the 7 months since telling almost opposite stories. A note before we begin, because intellectual honesty requires it. Everything here reflects research done specifically for this video, checked against the numbers as they stood at the time of recording. Markets do not hold still for anyone's convenience, and some of what follows may look slightly dated by the time you're watching it. This is not financial advice, and it is not a signal to do anything with your money. It is an attempt at clarity, a way of understanding the machinery so that whatever you decide with your eyes open. Whatever you do with your capital should involve someone who actually knows your circumstances. Now, to the document, FOMC is shorthand for the Federal Open Market Committee, the 12-member body inside the Federal Reserve charged with setting the interest rate policy of the world's largest economy. 8 times a year they meet. They examine inflation, employment, output, global conditions, and they vote. Their conclusions do not stay inside that room. They travel outward into mortgage rates, business loans, currency markets, bond yields, and yes, into the price you pay for an ounce of gold or silver. On the day of the meeting, the Fed issues a short public statement announcing what was decided. 3 weeks later comes something far more revealing: the full minutes, a detailed account of the actual argument, who worried about what, who used which words, where the committee disagreed, and by how much. It is the closest thing the public gets to sitting in the room. And this particular set of minutes, dropping August 19th, carries unusual weight. At the July 29th to 30th meeting, the Fed voted to hold its benchmark rate at 3.75%. That much was announced immediately. What was not announced, and what Wednesday's minutes will reveal in full, is how divided the room actually was. The vote was 9-3. 3 regional Fed presidents wanted to hike immediately. The majority held the line, but not by much. 9-3 is not a routine outcome. Most FOMC votes are close to unanimous. A split this wide is the committee's way of telling you, in the most formal language it has available, that this was genuinely contested ground, and that a modest shift in the data could tip 3 dissenters into 5. Then came the data the committee did not have in the room. July's consumer price index came in at 3.4% year over year, the second straight month of cooling. The producer price index, which tracks what businesses pay before those costs reach you, came in flat against an expected rise. And July's non-farm payroll showed a loss of roughly 23,000 jobs, against forecasts calling for a gain near 80,000. None of that appears anywhere in Wednesday's minutes because none of it existed yet when the meeting happened. The document is a snapshot of an argument that occurred before the facts changed. That gap between the debate as it was and the data as it now stands is exactly where the opportunity for a sharp-eyed investor lives. So here is what to actually look for. First, how the 3 dissenters framed their case. Were they alarmed chiefly by the headline inflation number, in which case this week's softer CPI print has already partly answered them? Or were they worried about something harder to fix, inflation expectations becoming unanchored, the public beginning to assume prices will keep climbing and behaving accordingly? A soft CPI print resolves the first worry. It does very little for the second. The tone of the dissent tells you which fight is actually still being fought. Second, watch for the specific language the majority used to describe what would push them toward a hike later this year. It is usually a sentence or two, buried mid-document, and it is the single most market-moving phrase in the entire release. A low bar, One more firm inflation print suggests this week's data may have already cleared the obstacle. A high bar, sustained, broad, multi-month evidence, means the ceiling on gold remains real, regardless of how encouraging this week looked. Third, note the specific adjectives used to describe inflation itself. Fading and normalizing mean one thing, persistent and entrenched mean quite another. The Fed's own history with the word transitory in 2021 makes every committee member acutely careful about word choice now, which means the words that do appear were chosen deliberately and are worth reading closely. Fourth, look for any hint, even a minority note. The members were already sensing labor market softness in the June data before July's dismal payrolls report existed. A room that was quietly worried before the bad number arrived tells a very different story than a room caught by surprise. And fifth, the rarest but most consequential signal. Did any single member raise, even hypothetically, the possibility of a rate cut before year's end? A mention like that would represent a genuine change in the direction of travel, that from will they hike to when might they cut, and gold would react to that shift before most investors had finished the sentence. The minutes do not land in a vacuum. Monday brings July industrial production. Tuesday, the minutes themselves. Wednesday morning after, the Philadelphia Fed Manufacturing Index and weekly jobless claims arrive together, shaping how the market digests what it read the day before. Friday closes the week with preliminary August PMI data, the first real look at how the current month is actually going. 5 releases, 1 continuous question. Is the Fed finished raising rates, or is there one more move left in it? Every one of those releases will tilt the scale a little further in one direction. And the minutes tell you exactly how much weight was on each side of that scale before this week's numbers arrived. Now, and this is where the two halves of this video meet, the same document, the same debate, the same 5 data points landing next week will not mean the same thing for gold and silver. Not remotely. Because these two metals, despite peaking on the identical trading day in January, have since walked entirely separate roads. And understanding why reveals something important about where each one actually stands today, and what would have to change for that to shift. If you have found this framework useful, the kind of context you cannot get from a scrolling ticker or a 30-second headline, this channel exists specifically to keep doing that every time something like this is about to move the market. Subscribing costs you nothing, and it means you will not miss the next one. I would genuinely appreciate it, and I read every comment, so if this changed how you are thinking about next week, tell me. Consider the raw numbers because they tell a story all their own. On January 28, 2026, gold touched an intraday all-time high of $5,489 an ounce. The very next day, January 29th, silver touched its own all-time high of $121.58 an ounce. Same week, same forces, both metals cresting a wave that had never existed before in either market's history. Today, gold trades around $4,365 an ounce, roughly 22% below that January peak. Silver trades around $64.75 an ounce, roughly 47% below its own peak. Gold has clawed back a substantial share of its correction. Silver has barely moved off the floor. Widen the lens to a full year and a different picture briefly appears. Gold up roughly 30% over the past 12 months. Silver up roughly 71%, the larger number a function of how low silver started a year ago rather than any recent strength. But narrow back to this calendar year alone, and the divergence returns in sharper focus. Gold is up modestly year to date, hovering near flat to slightly positive. Silver is down close to 8.9% for the year. And the gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, sits near 67, compared with a 50-year historical average closer to 65. One sentence holds the whole story. Gold has recovered most of what it lost since January. Silver has recovered very little of it. To understand the split, return to why the two metals rose together in the first place. January of this year was a genuinely rare convergence, an escalating confrontation involving Iran and the accompanying fear of an energy shock, worry that oil-driven inflation would force the Fed into a more aggressive posture, mounting concern over the trajectory of American federal debt and its rising interest burden, and a broad institutional retreat from risk assets into hard assets that answer to no government's promise, geopolitical anxiety at its peak, inflation anxiety at its peak, currency credibility anxiety at its peak. In that environment, gold and silver were treated identically, both monetary insurance, both a hedge against a system that seemed to be losing its footing, and so both set records within a day of each other. Then the environment changed, as environments do. Oil stabilized somewhat as the initial shock was absorbed. The Fed signaled it might need to raise rates again to keep that inflation contained. The dollar firmed as hike expectations rose. Real yields, the return you earn after subtracting inflation, climbed as rates held and inflation cooled. And the market, no longer gripped by maximum fear, began asking a more discriminating question. Not, should I own precious metals, but why specifically am I holding this one? The answers for gold and silver turned out to diverge sharply. Gold's case remained intact because it never depended on crisis conditions to begin with. Central banks kept buying at a remarkable clip, roughly 289 tons globally in the second quarter alone, with China alone adding some 20 tons in July, its 21st consecutive month of accumulation. The argument for gold as a currency alternative, a hedge against fiscal drift, and a form of geopolitical insurance does not require headlines to stay dramatic. It is quietly valid on a Tuesday in August the same way it was valid at the height of a crisis in January. Investors holding gold through the correction were holding it for reasons that simply had not expired. Silver's case is more entangled with the business cycle, and that entanglement is the whole story. Something close to 59% of all silver consumed worldwide goes into industrial use. Solar panels, electric vehicles, artificial intelligence infrastructure, data centers, electronics, medical equipment. Silver is, at its core, an industrial material that happens to also behave like a monetary one, not the reverse. And here is why that distinction matters so much in an environment shaped by rate hike anxiety. When the economy looks like it might slow, when manufacturing surveys soften and consumer spending pulls back, industrial demand weakens, and industrial demand is silver's single largest source of demand. You cannot separate silver's industrial identity from the macro weather the way you can with gold. The same rate hike fear that pressures gold through the opportunity cost channel pressures silver twice, through that same channel and again through the industrial demand channel. Gold faces one headwind, silver faces two. So the market did something entirely rational, if a little unsentimental. It kept pricing gold as a monetary asset, straight through the correction and the recovery, and it began pricing silver more like an industrial commodity, closer in temperament to copper or aluminum, whose fortunes rise and fall with economic activity. Not because silver's underlying supply story stopped being real, but because 2026's macro environment has rewarded assets that do not need economic growth to justify holding them. Silver, unfortunately, needs growth more than gold does, which brings the FOMC minutes back into the frame, because this is precisely where the two halves of today's discussion intersect. If Wednesday's minutes reveal a genuinely dovish tilt, the three dissenters sounding, in hindsight, unconvincing given this week's cooler data, the majority's language soft enough that a September hold looks close to certain, perhaps even one member floating the idea of a future cut. Gold's reaction will be swift and largely uncomplicated. Falling rate hike expectations lower gold's opportunity cost, weaken the dollar, and pull real yields down. Three tailwinds from one document. It is about as clean a catalyst as this market offers, and it all runs through Wednesday afternoon. Silver's reaction to the same dovish minutes would also be positive. But the arithmetic is messier. Lower rate expectations do reduce the cost of holding silver, exactly as with gold. But if the Fed is easing because the economy is genuinely weakening, softer employment, slower manufacturing, cautious consumers, then the very forces that would give silver its monetary lift are simultaneously eroding its industrial demand. One tailwind, one headwind, arriving in the same document. The net effect tends to be positive, but noticeably smaller and slower than gold's. Reverse the scenario. If the minutes rate hawkish, the dissenters well organized and persuasive, the majority using harder language about what would justify a hike, no softening in how inflation is described, gold runs into a ceiling. Rate hike fear returns, opportunity cost rises, the dollar firms. Not the outcome gold investors are hoping to see on Wednesday. For silver, that same hawkish outcome is worse. Higher rates slow the economy, a slower economy curbs industrial output, and reduced industrial output cuts into the demand category that accounts for well over half of silver's annual consumption. Silver takes the hit through the rate channel, the dollar channel, and the industrial channel simultaneously. Three headwinds against gold's two. That asymmetry is a large part of why silver's recovery from January has lagged so visibly behind gold's, which raises the question every silver investor is quietly sitting with. When does the gap close? History offers a fairly consistent answer. In every major precious metals bull cycle of the modern era, silver has eventually closed its distance from gold, and done so faster than the gap originally opened. The gold-silver ratio does not stay stretched indefinitely, but the historical record suggests that compression tends to require two conditions, arriving at roughly the same time, and neither one has fully arrived yet. The first condition is a genuine shift in the Fed's narrative. Not merely a pause, but a real pivot from are they still hiking to when do they start cutting. When that shift occurs, silver's monetary case strengthens at precisely the moment lower rates begin stimulating the economic activity that stabilizes its industrial demand. Both headwinds ease together, Right now, with September hike odds sitting near 30%, that first condition is partially in motion. This week's CPI and PPI data moved in the right direction for it. Wednesday's minutes will either confirm that movement or push back against it. The second condition is a shift in how widely silver's physical supply picture is understood. This is now the sixth consecutive year of a global supply deficit, with this year's shortfall estimated near 46.3 million ounces, and roughly 1.1 billion ounces drawn from global stockpiles cumulatively since 2021. COMEX registered silver inventories have fallen from around 150 million ounces in early 2021 to under 70 million ounces by late 2025. When numbers like that stop being the province of specialists and start entering the same mainstream conversation that central bank gold buying already occupies, silver's market classification tends to shift away from an industrial commodity and toward a scarce monetary asset with a genuine structural supply problem. That reclassification, historically, has tended to happen quickly once it starts. The ratio, sitting near 67 today, is the market's way of telling you that the first condition is approaching and the second has not yet arrived. Both are worth watching, and both will be shaped, at least in part, by what emerges from Wednesday's minutes. So here is what to carry forward from all of this. The FOMC minutes landing on August 19th are not routine paperwork to be skimmed and forgotten. They are the detailed record of a genuine argument inside the world's most consequential rate-setting body, recorded at a moment when three members wanted to move immediately, and the majority held them back by the narrowest of margins. A 9-3 vote that tells you, in the Fed's own formal language, that this fight was closer than the headline let on. Reading the document well means looking past the summary and watching 5 specific things: how the dissenters actually argued their case, what precise conditions the majority named as their trigger for hiking, how they characterized inflation's nature and trajectory, what they said about the labor market before this week's grim jobs number arrived, and whether even one member introduced the idea of a rate cut before year's end. Those 5 details will tell you more about where gold is headed into the fourth quarter than any single price target from any bank on Wall Street. And as you follow next week's coverage of those minutes, carry the second half of this conversation with you too. Gold and silver are not, right now, the same trade, even though they share a birthday at the top of the market. They separated because one retained its identity as a monetary asset through a rate hike scare, and the other reverted to being priced like an industrial commodity in a slowing, cautious economy. The same document that could be powerfully supportive for gold on Wednesday carries a more complicated set of implications for silver. Not because silver's underlying fundamentals are weak, but because its dominant source of demand is tied to economic activity, in a way gold's simply is not. Gold has one Federal Reserve risk running through it. Silver has 2. But silver also holds 2 conditions that could close the gap with gold, and one of them is already, quietly, beginning to move. That is the purpose of this channel, not to hand you a prediction, but to give you the framework to understand what you are looking at when the moment arrives. If this breakdown of the FOMC minutes, or the explanation of why gold and silver have parted ways this year, gave you a clearer picture than you had 10 minutes ago, that is exactly what this research was built to do. I would rather earn a subscription with substance than beg for one with noise. So if this helped, consider sticking around for the next one. There will be another document, another divergence, another week, where the headline says one thing and the underlying data says something more interesting. Before you go, I want to hear from you directly because it genuinely shapes what I cover next. Going into Wednesday's minutes, are you watching gold, silver, or both? And which part of today's breakdown changed how you're thinking about it? The dissent, the industrial demand angle, something else entirely? Drop it in the comments below. I read every one of them. Thank you for spending this time with me, and I will see you in the next one. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.